Hey everyone, and thanks for jumping back into the Macroverse. Today, we're going to talk about historical recession statistics and the relationship between them and the S&P 500. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out Into the Cryptoverse Premium at intothecryptoverse.com. We do have a sale running right now, so make sure you check that out. Link is in the description below. Let's go ahead and jump in. Now, admittedly, this video is not going to be very riveting, as we're going to be systematically going through a table. But again, I mean, why should it be any different than any of my other videos? I know they're not always the most exciting to listen to. But I have received a lot of questions about relationships between when recession starts, when it ends, when it's declared, and sort of what is the S&P 500 doing during that time. And because I've received so many questions, I wanted to spend a little bit of time going through systematically what we saw during prior recessions. Now, I do know that a video with recession in the title is going to at least lead to some controversial opinions, and I think that's fine. I will say, whether you think we're heading for a recession or not, it might be useful to still watch this video, as I imagine you would at least be in agreement that at some point we'll go into a recession, whether it's in the next year or two, or maybe 10 years down the road. I think there's still something that we can all learn. After all, I mean, for every piece of evidence that you can find pointing us towards a potential recession, there's plenty of indicators that you could sort of conjure up to sort of say that we're not. And so I do want to at least be respectful of both opinions there. Of course, you guys know my general opinion, but I do want to go through systematically a lot of these prior recessions and talk about when did the S&P 500 bottom with respect to the recession starting and when it was actually declared, okay? Now, let's go through each of these columns. So again, we have recessions going back to the 1850s here. Obviously, only some of the columns are populated for some of the recessions that occurred longer ago, just because we don't have as much data on them. But the first column shows you when the recession started. The second one shows you when it ended, and the third one shows you the duration in days, okay? So you can see that the average length of a recession is approximately 381 days, or about 1 year, right? So the average recession going all the way back to the 1850s lasts approximately 1 year. Now, the declaration date is different than when the recession actually starts. The recession, when it starts, is not normally declared at the time. It's only done in sort of retrospect. And here's something that's interesting as well. If you look at some of the time frames on this, like in 2001, the recession started in March and it ended in November 1st. But it wasn't declared until November 26th. So it was declared not only well after the recession started, 270 days, but it was also declared after it ended too, which is something important to sort of think about. You can see that some recessions only last like 60 days, like what we had in 2020, but others can last, over 100 days or over 200, 300 days. Now, this one here, this column right here, again shows you the length of time between when it started and when it was actually declared. And you can see that the average length of time between when it started and when it was actually declared is 234 days. Some of them being closer to, say, 6 or 9 months, and sometimes being closer to around a year. So let's just say it normally takes 6 to 12 months to actually call a recession after it already started, okay? Now, I will address a question that would be bound to come up, and that is, well, what if we've already been in a recession since 2022 started? And one of the reasons that someone might say that is, well, if you look at real GDP, it put in 2 consecutive quarters back over here, and they didn't call it a recession back then. Well, sort of the counterpoint is, well, if you thought that was a recession, then why would you think now it is? Because if you use that metric, real GDP has actually been putting in new highs. So you can't even point to real GDP right now as evidence that we're in a recession, because again, it's still continuing to put in new all-time highs. Furthermore, the unemployment rate is more the measure that I think they use, and you can see the unemployment rate whenever it starts to go up, which is this orange line. That is what corresponds to a recession. And right now, it just simply has not made that move off the lows. Not any sustained move. I mean, we are up slightly over the last month, but still at relatively historical lows on the unemployment rate. And so I don't think they're going to say that a recession started in January of 2022 when the unemployment rate was still trending down. You can see that historical recessions generally occur after the unemployment rate starts to go up. Okay? So because of that, I don't think that we can make the case that I don't think we can really make the case that we were in a recession in 2022. I think it's more likely than not that it will not be known as a recession in 2022, although it could, of course, occur later on this year. Now, going back to this table, the next column shows you the max drawdown, okay, and then the next one shows you from the start of the recession to sort of the low drawdown. Now, these columns might sound somewhat or they might be somewhat confusing. There is a little bit of a description down here, and I'll just read it and I'll try to explain it. But the S&P max drawdown measures the percentage price change from peak to trough of the S&P during the recession. And the peak is chosen to just be the highest price that occurs before the trough, and then in some recessions there is no clear trough. But the start to the S&P low just measures the change from the start of the recession to the low. So sometimes you might have a recession start, but then the price or the S&P 500 actually goes up in the short term, and then it goes down later. So that's why you might see some differences in these two columns. But if you just look at sort of the max drawdown, which is probably what more people are interested in anyways, you can see that it averages about 31%. This is from when the recession starts, okay? Because that's an important distinction. If you look at, say, the dot-com crash, it says that the max drawdown was 26%. But again, if you were to go look at the S&P 500 during the dot-com crash, we know that it actually went down about 50%. So the reason that it's not showing anymore is because, again, it's only looking at once the recession started, what was the max drawdown, right? I mean, at this point, there shouldn't really be too much. I mean, people shouldn't be that concerned about, how much will it be down from the peak when it's not like you can go back in time and sort of change anything. But what could happen for the S&P 500 on average if there is a recession from the point of us actually being in one? Okay. Now, going back to some of these columns over here, and looking at sort of the declaration date and when it actually started. Again, this is one where it was declared after it was over. But there are some where it was declared. There's still plenty where it was declared before it was over. For instance, in this example, the recession started in July of 1981. It was declared a recession in January of 1982, and then the recession ended in November of 1982. So just because they sometimes declare it after it's over, that's not always the case. Now, I also want to show you the length of time between when a recession starts and the S&P 500 low. On average, it takes 273 days. Sometimes it's been relatively short, like 51 days, 86 days, 82, 75, and then other times it's taken a much longer period of time, like about a year or more. Okay, so that's something that I think we need to keep in mind as well. But here's my favorite column. And that's the declaration to the S&P 500 low. All right. Now, again, the start of the recession is different than when it's declared. And again, it's declared by the National Bureau of Economic Research, or the NBER. If you were to wait until the National Bureau of Economic Research declares a recession to sort of think that the bottom might be in, you could be mistaken, because the average amount of time that the average amount of days that the S&P bottomed after the recession is called is -15. So think about that for a minute. Once the recession is declared, then on average, at least looking at, the last 6 recessions, on average, the low was already in. And if you take each one individually, in 2020, it was 77 days before. In 2007, it was 98 days after. The next one was 66 days before. The next one was 196 days before. The next one was 218 days after. And then the next one was -68 days before, or just 68 days before. So it shows you that if you wait until the National Bureau of Economic Research declares a recession to assume the low is in, then the low could already be in, right? Again, there's examples where they don't even declare a recession until the recession's actually already over. So that's something important to keep in mind. Now, again, sort of going back to the point of, well, if the recession is backdated until the beginning of 2022, then maybe you could argue that October was the low. But again, as I mentioned, the counterpoint to all that is the recessions occur when the unemployment rate is going up, not when it's trending down, which it has been for basically, basically for the last couple of years. It's more or less just been trending down. I mean, it's possible that it's already found its low here at 3.4%, but there's no guarantees if that is the low or not, and we'll just have to simply wait and see. So I think that looking at this is useful in terms of trying to navigate various things. If you wait until the recession actually occurs or at least to when it's declared, if you wait until that, the S&P 500 could have already bought. All right. Now, there is an important caveat, and that is if we don't get a recession. If you don't get a recession, the average length of a bear market, I believe, is about 9 months, which is more or less generally in line with what we've seen the S&P 500 do in 2022, right? It was essentially from December, January, all the way down until October. So it's a pretty average length for a bear market that does not include a recession. But recessionary bear markets can last well over a year, right? They can be a year and a half, they can be 2 years, so on and so forth. I think the average length of time is maybe about a year and a half or a little bit less, but it goes to show you why there are so many people that are already in the camp that this is the low, because it's the average length of time for a bear market. If you're in the camp that this is not the low, it's probably because you think that a recession is coming, and recessionary bear markets tend to last longer. Okay, so I think that is sort of what is causing the most friction between people as to whether we're going to actually get a recession or not. Now, history would show, if you look at a lot of the different indicators, like the inversion of the yield curve, and so on and so forth, it would imply that we will eventually get one before we come out of it. But even then, it can still take longer than a lot of people expect. For instance, if you were to go look at the yield curve inversion, it's a pretty common thing, I think, for people to say, well, the yield curve's inverted, that means we're in a recession. But what history shows us, in fact, is that when the 3-month is inverted, the 10-year, we're typically, when it inverts, we're typically not in a recession. I mean, look back for the last several decades. When it inverts, we're not in a recession. It's when it uninverts that we go into a recession. So the point is, it's hard to know exactly when this is going to occur, but history shows us that when it does occur, it typically leads into a recession. And these recessions can obviously last a few months. They can last over a year, or maybe more than a year, or about a year, more than a year. But what is interesting in basically all of them is that when you get a recession, the S&P 500 does experience a drawdown, and the average drawdown from when it starts is 31%. Now, sometimes the drawdown has been somewhat tempered at 8 or 9%, and then other times it's been particularly bad, like 55%. To give you an idea, if a recession were to start, say, April 1st, and let's just say we're at the current price, an 8% drawdown basically just gets you back around the prior low. Okay, not even to the prior low. But the average drawdown is 31%. So the average drawdown from these current levels would actually get the S&P 500 down to 2,700. That would be a pretty big drop for the S&P 500. Now, if it were to drop simply to say, what we saw back in the 1980s, which might be a somewhat comparable time when we also were coming out of a period of high inflation. You can see we had 2 short recessions here, 17% and 24%. A 17% drop from the current price would get you down to about 3,300 S&P. A 24%, I believe that was the other one. 24% would get you down to around 3,000. So it shows you that if the U.S. economy enters into a recession, then the downside risk still remains for the S&P 500. And we spent a lot of time sort of outlining the risk involved. And this is, again, you have to be careful with how you phrase it, because if you just look at the yield curve and say, "Oh, we're in a recession because it's inverted," or if you look at real GDP and say, "Well, we had 2 consecutive quarters, so the recession already occurred," you're also kind of ignoring the unemployment rate and how it is still sitting at more or less a secular low for this business cycle. Furthermore, if you use the unemployment rate to say we're not in a recession, the counterpoint to that is that normally it sort of hits these lowest points just before a recession occurs. So, you have to sort of take some of that stuff with a grain of salt and say, yeah, I mean, it's evidence right now that we're not in one, but it doesn't mean that we can't get into one. Okay. Now, I believe the Atlanta Fed is forecasting pretty positive real GDP growth for the first quarter of 2023, and if this is the case, then it looks like that Q1 will not be considered a recession, especially considering the unemployment rate is still at a relatively low level. I suppose if this marks the low on the unemployment rate, then they could backdate it until part of Q1. But I imagine that they wouldn't do that until 3 to 6 months from now. And that's only assuming that the unemployment rate starts to go up now. If the unemployment rate stays at a low level for the next 3 to 6 months, then you push that time frame even further out, right? And further out, depending on how long it takes for it to actually go up. And I think the difficult part here is that the Fed does seem somewhat, determined to continue to tighten or to keep monetary policy, very tight until you see the loosening of the labor market. So to some degree, it seems like it's only a matter of time before the unemployment rate starts to go up. And it kind of seems like once that occurs, then maybe the Fed will actually start to think about pivoting. But until that occurs, I think the Fed will continue on with their general mantra of higher for longer, and likely what it means is the markets are pricing in rate cuts, too far in advance as to when the rate cuts would actually occur. Okay, the market, if you think about recessions and what you would generally expect in a recession, normally you would expect rate cuts, right? So if you were to go look at United States interest rates, so I think this is a good one to look at and to really digest a little bit. So this chart here shows you the effective Fed funds rate. You'll see that these gray shaded regions, generally speaking, you'll see that when we go into a recession, the Fed is cutting. Normally they're cutting before we get into a recession. Right now, they're still raising, okay? And you have to ask yourself, what would cause the market to price in rate cuts starting as early as July? Especially considering that Powell has said many times that they're not forecasting rate cuts this year. Now, that doesn't mean they won't have any rate cuts this year, but the market is clearly suggesting that a recession will occur, and it would probably starting to occur within the next few months. Because why else would the market consider all these rate cuts? It just doesn't, it wouldn't make a whole lot of sense for the Fed to cut rates this drastically if we're not in a recession, especially considering how Powell has sort of gone on and on and on for over the last year as to how they will remain higher for longer. And even at the last meeting, the last thing he said before he walked off stage was, that they're not planning on cutting rates this year. Despite everything that he said, the market doesn't believe him. And the reason the market doesn't believe him is because the market thinks, I believe, that we're going into a recession. That's why you see these rate cuts being priced in. And again, if you go back to the effective Fed funds rate, you'll see that they're typically cutting in a recession. So with all this in mind, that's why I think it's important to continue to sort of keep a close eye here on the S&P 500, because if the United States enters into a recession, it could easily take out the October low. Okay. Now, the reason why we'd have to be on full alert if and when that occurs is because if the unemployment rate starts to go up, we know that the S&P 500 tends to bottom before the unemployment rate peaks. So if you go take a look at the unemployment rate, what you'll notice is that the S&P 500 tends to bottom before the unemployment rate peaks, right? So like it bottomed here and the unemployment rate peaked just a bit later. Here, the S&P 500 bottomed in March 2009, but the unemployment rate did not peak until a few months after that, maybe like half a year after that. So what you're looking for, essentially, I think, is the unemployment rate to start going up. If you wait for the unemployment rate to peak, there's a good chance that the S&P 500 is bottomed. Furthermore, if you wait until a recession is declared, there's a chance that on average, the market bottom has already occurred. So rather than rely on things like the National Bureau of Economic Research to tell you when the recession is going to start, especially considering there's piece of evidence in here to show you that there are times when by the time they declare it, the recession's already over. Here's another example. This recession started in July of 1990. It ended in March of 1991. The recession was not even declared until April of 1991. So, waiting until the National Bureau of Economic Research tells you that the recession is here is probably not going to be a great strategy in terms of trying to figure out, when is the S&P 500 actually bottomed. It is possible that it could bottom after it's declared, but on average, you can see that at least actually, even if you don't look at the average days here, but if you just look at, the 6 data points, 4 of the 6 times, or 2/3 of the time, the market's already bottomed when the recession is already declared. And again, it's probably due in large part due to them relying on lagging indicators. I also think there might be some element to wanting to sort of declare it once the worst is already over so that they can maybe be somewhat optimistic going forward. But I think that's something to consider. So if the Fed is right in their forecast for real GDP, if you looked at the recent summary of economic projections, they're really not forecasting very high real GDP for 2023, less than 1%. But the Atlanta Fed is already forecasting 2 to 3%, I believe, in real GDP for Q1. So I think if the Fed ultimately thinks that we're not going to see that Q1 great growth sustained, then the implication is that they think there's going to be some contractionary periods during this year. Now, the main difference between potentially getting 2 consecutive quarters of negative GDP this time, as opposed to 2022, is that this time it's much more likely to also correspond to a material rise in the unemployment rate. And so, if you imagine a potential scenario where, you see the layoffs in the headlines, right? It seems like just every day, basically, there's a new company announcing layoffs. At some point, the market is probably just no longer going to be able to absorb all these layoffs, and it'll start to appear in other channels or in other metrics. So I think that one potential route that we could take is that the S&P continues to sort of hold on for a little bit, but maybe by the second or third quarter of this year, it goes and puts in a new low. And then by the third or fourth quarter, maybe the National Bureau of Economic Research finally declares it a recession. Maybe they backdate it until April or something, or May or June, and then say, all right, well, we're in a recession. By that point, the market could have already bottomed. Okay. So again, it's just something to think about. And I know the biggest counterpoint to all this as well, what if October is the bottom? I think that the best case to make for the October being the bottom is that you just simply think we're going to avoid a recession. So if you're in the camp that thinks we're going to avoid a recession for whatever reason, which again, there's no guarantee we get a recession. If you're in the camp that you think we're going to avoid a recession, then you're probably in the camp that the October low is the low. If you think we are going to get a recession, then history would show that you're still much more likely to see a drawdown in the S&P 500 when the recession actually starts, and the recession doesn't normally start until the unemployment rate starts to go up. Thank you guys for tuning in. Make sure you subscribe. Again, check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. Links in the description below, and I'll see you guys next time. Bye.